Ladies and gentlemen, good day and welcome to Jana Small Finance Bank Limited Q3 FY26 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chintan Shah from ICICI Securities. Thank you, and over to you, sir.
Thank you, Bhumi. Good evening, everyone, and welcome to the Q3 FY26 results conference call of Jana Small Finance Bank. We would like to thank Jana Small Finance Bank for giving us the opportunity to host their Concall. From the management, we have Mr. Ajay Kanwal, Managing Director and Chief Executive Officer, Mr. K.S. Raman, Executive Director, Mr. Abhilash Sandur, Chief Financial Officer, and other senior management team members. Now, without further ado, I would now like to hand over the floor to Mr. MD, sir, who will give his opening remarks, and then post which we can open the floor for questions. Thank you, and over to you, sir.
Thank you very much, Chintan, and good evening to everyone. I would like to talk through Jana's Q3 and 9 months performance through the presentation that we uploaded on the stock exchanges. I'll be referring to the specific pages, and I'll start with page number 3. What we were hoping to see in Q2, we finally seen in Q3. So we are a quarter late in what we thought would be a bottoming out of all issues, specifically the slippages and SMA trend. But we have seen that decisively happen in Q3. I'm happy to report that we have seen not just slippage in the SMA trend, which had peaked in the first quarter of this year, now has shown a sustainable and strong drop. To make sure that we are very comfortable with the direction the bank is taking, I've also done March 2026 expected high-level guidances, and I must tell you that the SMA and slippages for March 26 will be lower than March 24, and the significance of that is in March 24 is when the MFI's flows up post that began. So we will go back to where we were in terms of slippage in SMA as of March 26. Of course, when I show you the details, you will see that the trend has already begun in a serious way. We've also had our highest disbursal, both in secured and unsecured, since Q1 of FY25. So this is the highest disbursal quarter in 18 months, including higher than Q4 of last year. Now, while secured has been a strong performance all through, what has made this specifically interesting is that the unsecured also, the disbursals have been our highest ever in the last 18 months. Our NIM, which has been on a decline, has first time shown a modest growth of 10 bits. We think this is the start because as unsecured businesses started growing and the cost of funds continue the decline, we will see further NIM improvement even in Q4. After seeing the stress of last year and figuring out that it's very difficult for a single lender to assume that his lending criteria and policies will hold him in good stead, we started putting our unsecured book under the guarantee program. Our total outstanding under the guarantee program is now 62%, though the meaningful claims from this will only start from next year. I have a small slide to share with you later. Our deposit book continues to show a robust growth of 30% year on year, while our cost of fund comes down. In Q3, which is last quarter, the RBI returned our application for Universal Bank. We are updating the Universal Bank application now on the shortages, and we will be resubmitting at an appropriate time. I now move to page 4. Now, what did we not do well? And I do think when we introspect, it does seem to us that we underjudged the velocity of the NPA flows in Q1 and were overtly bullish on the improvement that we thought will happen in Q2. The Q2 expectation actually came through in Q3. So we were a quarter early in judging of how we would turn around the book. I've also explained in detail of where were the challenges, and the reason of showing that is when you look forward on what to expect from the bank, this will be a good things to kind of focus on what to expect. First is our unsecured book had a slow growth. It costed us a NIM compression of 20 bips. Now the growth is back. We should expect positive contribution on NIMs. Our secured book has grown faster than we anticipated. It gave us a positive of 40 crores on income line. But because you book all the costs upfront, whether it is a valuation or a legal or a sourcing or an incentive, the impact on cost is 54 crores. It is positive for the future, but certainly for the first 9 months has dragged us a 14 crores down. We had an increased collection and recovery cost that costed us 40 crores in the 9 months. Now that things have ebbed out, this should also be lowering itself. There has been a change in the labor code, which is not just for the bank, but for all companies. That impacted us by 12 crores. And of course, the high Q1 slippages, which gave us a 110 crore drop. And the reason for showing this less for anything else, but to give a good understanding of how things are now expected to change. I move on to slide 5. Here's the credit cost. As you can see, quarter 1 was 196, quarter 2 204, quarter 3 277. We are already on early Feb. We have seen the January numbers. It's fair to say that we should expect a lowest credit cost for the year coming up in quarter 4, which I have stated here as 170 to 190 crores as a range. Our closing gross NPA as of quarter 3 is also gone down to 829. We expect that to remain flat. That is between 830 to 850 crores in the coming quarter. Now, so it's pretty evident if you read the numbers that we have peaked out on our credit cost. We will see significant reduction next quarter itself, and so also our GNPA balances. And I now take you to page 6. This is a new slide we are giving, which basically shows SMA book, which is SMA 012 of the bank. Here again, you can see that our peak in the overall SMA book was at 6.2 in June, which was end of first quarter. It has come down to 4.6, and we expect it to be at 4% when we finish the year. Unsecured peaked at 7.3%, which is on the right-hand side, as of June, down to 4.2, expected to be around 3.8% when we finish the year. Similarly, secured, which went up to 5.7, is down to 4.8, expected to come down to 4% when we finish the year. The SMA trend is a clear indication of why the credit cost will now be ebbed out. I did speak of strategic move made by the bank, which is to ensure that event risk out of our control should not be a source of significant challenge for us in the future. We started putting our MFI book under the guarantee program. I have shown here, which is on slide 7, how the unsecured book will give us the returns in terms of recoveries from the guarantee program in the future. So let me explain this. This is only disbursals that we expect till March 2026. So I'm taking a point of time P&L for how the guarantee program that we have spent money on will impact. So we expect to close the unsecured book around 9,667 as of March 26. It will take up the covered under guarantee to about 7,000 crores. Currently, we are 62% of outstanding under the guarantee program. By March, it will become 72%. This has costed us this year roughly about 51 crores with about 12 crores of eligible claims, which we should receive money in Q4. Next year, we expect for the same 7,000 crores as the book starts paying down. Another 70 crores is premium to be paid. But we do expect based on the flows, because the claims are given 18 months after the close of the financial year. That means we should expect 120 crores, which is largely from the 2,535 crores under the guarantee program that you see under FY25. Similarly, in FY28, we should expect around 300 crores, which largely is from the 7,014 crores of outstanding, which is under FY26. So yes, we've had a year where we've had to pay out guarantee commission, but the next 2 years, it will benefit in terms of returns coming out from the NPA that we have seen. I have not put FY27 and 28 because all depends on how much disbursals you do and what kind of flows you have. But I've just kept it to a point of time of FY26 and given you a clear indication of what you should expect in terms of reversals to our credit cost, both next year and the year after. This is purely based on outstanding and guarantee program of March 2026 and 2025. I want to take you the P&L summary. Q3 PAT is at 10 crores. It is the bottom quarter for us. We are giving a expectation of Q4 26 PAT of between 140 to 160 crores. We are hoping to have the meeting and the results by the 30th of April. I now move on to slide number 9, where you can see that we've had a very strong growth in CASA. Year-to-date growth is 29%. Quarter-on-quarter is 13%, so has been a very strong CASA. CASA has now moved to 20%. This year we have grown our term deposit 13%. Our total deposits now stand at 33,733 crores with growth this year of 16. For people who remember, our guidance was to be at 20% and we should be meeting our guidance for the same. While we have grown our deposits in a very strong way, our cost of deposits have now fallen to 7.7. Given that we already finished nearly 38 days of this quarter, we expect, based on what we see, our cost to come down further to 7.5% on the cost of funds. Our secured group continues to grow strongly, mainly led by affordable housing, gold loans and vehicle loans. On the unsecured side, we've had our best quarter for the last 18 months. We continue to see the same strong trend even in Jan. Our BC book, which has been a drag, has stabilized and we will start seeing growth. We can also see that the BC book collections are now at closer to 99%, which we have seen only after a very long time. I now move on to slide number 12 because I do know there will be a lot of questions so that we can all have a look at the bank's asset book in a fair amount of granularity. Our affordable housing, which is the largest secured asset book at 7,500, year-on-year of 35.3%. Micro at 6,201 at 14.5% year-on-year growth. MSME at 4,830, which is a 24% year-on-year growth. NBFCs at 2,145. Vehicle loans at 1,554, which is 83% growth. Gold loan continues to grow very strongly. Now it's at 1,752 with 194% growth. And what has been a big drag on our P&L, which is unsecured advances, has actually seen a quarter-on-quarter growth of 4.1 and has first time made the year-on-year growth positive to 2%, which has been a big change for our P&L. I now move on to slide number 15. While we did get distracted and jostled a lot with collections, we never changed our core strategy. Our core strategy of becoming 80% secured, 20% unsecured remains very much intact. We are at 73% secured. The only change to the strategy is we said we'll be 20% unsecured. Now out of that 20% unsecured, roughly about 62% and by March 72% will be under a guarantee program. So we are in a way much more secured as a bank than we originally began when we thought of it. As we look back at April 2025, and this is the time where we decided that given this way the MFI business behaves, it's better to make sure that we start buying guarantee for any event risk. Having said that, our idea of becoming an anchor bank for our customers, which we regularly show on this slide, you can see is showing an all-round growth. Compared to last year, the average relationship is up to 4, gold penetration up from 2 to 2.6, CASA continues to be at the same levels. Our business loan program is up at 21%, two-wheeler has moved up to 1.2, time deposit at 21. So the whole idea that we're creating operating leverage by doing multiple products with the same customer very much holds true for us and hasn't been an area that has got weakened in all the slowdown at MFI or the collection challenges. I will now just do the last slide so that we have enough time for questions. And I will move to slide number 18. As you can see, CASA first now stands at 6,742 crores, year-on-year growth rate of 41.4%. Our time deposit at 26,991, year-on-year growth rate at 27.9%. Our CASA ratio moves up to 20, while cost of funds dropped to a 7.7. For folks who want to know more details about it, our LCR has normalized to 120, and we continue to be a bank which focuses on long tenor deposits with 90.8% of our bulk deposit 1 year and above, and 90.4% of our retail deposits with 1 year and above. I think that should give you a good sense of what we missed as a management team. The high slippages in Q1, less recovery than we anticipated Q2, but happy to report that Q3 has kind of paid for all of that, and we are back to our growth path, both on profitability as well as unsecured business and secured business, and of course deposits doing very strongly. I'll stop here and I will give it back to you, Chintan, and we can open up for questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Aman Patle from Invest4Edu. Please go ahead.
Hello.
Hi.
Yes,
Hi,
please
Aman.
go ahead.
Yes, sir. I have two questions. First one is, has the credit cost bottomed out, and what is the outlook on the credit cost ratio for the next year? Second one is, sure.
Go ahead. Please go ahead. Finish your
Okay, sir. And second one is, did your universal bank application stop you from kitchen thinking earlier, and you choose to take quarterly approach to provisioning? And the last one is, with your signal of credit cost normalizing, increasing NIMs and healthy asset growth, what should we expect from ROA and ROE for the next year? Yeah,
right, Aman. Okay. So let me first answer the credit cost question.
Yeah.
So as you can see, so one is we've given a clear signal that our credit cost in quarter 4 will be down in a significant way from quarter 3.
Okay.
And since our estimate book, if you can see in page 6, is also on a decline. So
Okay.
we do expect our credit cost to be on a sustainable downtrend. If you ask me where is it rough and ready on credit cost anticipation, I think we're close to about 2.6 odd percent or maybe 2.7% for this financial year. That's how we see it. In the coming year, we expect the credit cost, given where our estimate book is and given the amount of provisioning we have done, to be in the 1.7 to 1.8 range. So that is in the credit cost, which will come down to 1.7 to 1.8, which will probably be one of our best credit costs in the last few years. Now from there, I will then link it to the ROA, ROE question you have and come to Universal Bank next.
Yes.
ROA, ROE, if you assume that our credit cost does come to 1.7 to 1.8 range, if you see our NIMs, which we anticipate will cross 7%, given our unsecured growth is now back. Unsecured growth back, Aman, has two possibilities there. One is, of course, the book is growing, so better income. Second, reduction in slippages, so lower interest in suspense.
Yes.
I've already spoken of reduction of provision cost when I spoke about reduction of credit cost.
Yes.
If I then add up, even if I assume the cost of funds to remain flat to Q4, which is about roughly 7.5, our secured is growing very well, so I don't see a challenge there. I would expect next year our ROE to be around 14 to 15%. Our NIM should be about 7 to 7.1.
Great.
And the ROA should be about 1.5 to 1.6%. So I think we will go back to a good performing year next year with ROAs of 1.5 to 1.6, ROE of 14 to 15, and the NIMs will be the 7 to 7.1% range. So that should give you a good sense of credit cost, ROAs and ROEs. On the universal bank application, did it stop us from kitchen sinking earlier? See, listen, there was always a possibility that you take a large amount of provision and then, after that, you really have quarters which kind of take away the challenges of higher provisioning. But honestly, with us, it was slightly different. Like I said, we were a bit more ambitious on what quarter 2 will do to quarter 1 slippages. And hence did not go in for a big provision in quarter 1. We also didn't anticipate Q1 to be so not good for us. As if you remember last year, we had a PAT of 500 crores and an actual provision of 300. You could have very well kept another 100 crores for additional provisioning last year itself out of the PAT of 500. But I think we kind of misjudged the flows of Q1 and the expected recovery of Q2. So really our kitchen sinking was never a thought for us because we didn't expect us to be so challenged in Q1 and Q2. It has got nothing to do with our universal bank application. Having said that, I've already given clear intent that we are going to resubmit. We continue to maintain the GNPA below 3 and net NPA below 1.
Thank you, sir. Thank you, sir.
Thanks, Anas.
Thank you. Our next question comes from the line of Smith Shah from Nirmal Bang. Please go ahead.
Good evening, sir. First of all, congratulations to you and your team for the good set of numbers. So I have two questions. My first question is that on the guarantee program, we do understand that the cost is upfront and the claim is subsequent. But can you please explain if you have any indication from the corporation on the claims next year?
So, listen, the way we work with them is the same corporation does work with us on ECLGS. And we have seen a very transparent efficient, and clear way of how they operate and what the conditions are. So our expectation is that they certainly will be giving us our necessary NPA values when they are due as per their process. Unfortunately, the process is that you get paid 18 months after closure of the financial year, which means everything that I put under the program in March 2025, I will be able to raise the claim only after September 2026. And what I have guaranteed up between March 25 and March 26, I'll be able to raise the claim only in after September 2027. So I think that time period is where we have to carry the provision, make sure we meet the 3 and the 1. And once the money comes, then we will to reverse it. I'm also aware from public disclosure that one of our HFB peers have received a significant amount from the same guarantee commission, same guarantee corporation. So I do expect that we will also be able to realize our NPA value in the same process. So we are confident that we'll get the money. It's just for us is a harder year because this year we are spending the money and our first sign of any recovery will come next year.
Okay, got it. And so should we expect about the cost to income to normalize given your unsecured collections and growing is coming back strongly? And if so, then by when we should be able to expect this?
I'll take that, Ajay. So for the cost income ratio to normalize, I think the unsecured book is growing now. So like we have indicated last quarter, there's a growth in unsecured book. And also slippages have reduced. So that will have a positive impact on the interest income. So having seen this for the previous quarter and the quarter which is coming up, I think cost income ratio should normalize by Q2 or Q3 in next financial year. So the cost income ratio estimate we are having around, considering all the factors which Ajay also mentioned earlier, cost income ratio should be around 60 to 62% when it normalizes. So that's where it should stand.
So just to add to that, the single biggest factor in our cost income has been really a drop of our income, led by, if you go back to March 24, we were at 9,800 crores of unsecured. We're down to a 9,000 odd now. That 800 crores of income disappearing had a big impact. And second, of course, is slippages causing interest in suspense. But the fact is that once this trajectory is back, we certainly will see the cost income around 60%. And it should not be a surprise because March 24, we were at 57% cost income. So getting to 60 by quarter 2, I think should be a reasonable expectation from all.
Understood, sir. And I have one last question, please. So, your affordable housing loan booking is loan book is growing at twice the pace of your micro lab books. So, is this a design or do you see stress in the micro lab books?
So first is, you're right, our affordable housing by design is moving faster than micro lab. And when we saw the challenges come through beginning April 2025, we decided that we will tighten up some of the micro lab conditions because there was a lot of noise in the market on small ticket lab, how it was not looking as good as it should have. That's been our bias. We also found that our ability to do anchor business, which is multi-product, tends to be much better when we do affordable housing. So consciously we move the incentives and the focus towards affordable housing. And that will be our strategy going forward too, where we will see affordable housing at a faster rate than micro lab. We do expect micro lab also to pick up because if you go back to March 24, this would be around a 25% number. We are down to a 14-15% number now. Given everything is becoming more clearer in terms of environment, I do see micro lab to reach the 20% growth rate in the following year.
Got it, sir. Thank you so much.
Thank you.
Thank you. Our next question comes from the line of Chaitya from Incred Equities. Please go ahead.
Hello. Thank you, sir, for the opportunity. I had just couple of questions. The first one is, so the slippages have declined by 25% from 591 crores to 440 crores. Can you elaborate on how this reduction is split between the secured and unsecured portfolios?
Sure. Why don't I let Raman, who's our AD, answer this question? Give Raman over to you.
Hi. The slippages of, we had 438 crores as compared to 590 crores. So if I look at the split between unsecured and secured, my secured slippage was about 196 crores and the unsecured slippage was 242 crores.
Okay.
Yeah.
The next question is,
Sorry, I just want to add one number. So previous quarter was 360.
Mm-hmm.
It fell down to 240. Okay, I should have said that. No worries at all.
Okay.
And similarly, we have seen a drop in the
Secured
fraud one also.
To 196. Yeah.
Okay. The next question is with respect to the resubmission of the universal bank application, do you expect any impact on the P&L in the coming financial year? If you can just highlight something on that.
Yeah. So listen, we never ever used universal bank approval in our projections for P&L. We always assume that if we get universal bank, then it will be a positive on top of whatever we are doing. So in our P&L projection in the past and even currently, we are not assuming that universal bank coming at what time frame and at what speed do we get what advantage. I just want to state that yes, universal bank will be a big advantage, especially on velocity of deposit collection, which is good today. But I guess that we'll continue with the same velocity with a lower cost of funds. So that was the primary reason we thought a universal bank will be an advantage. It would also be an advantage for doing more supply chain and trade receivables, etc. Because as we move up the MSME chain, not having a small finance stack does help you with a lot of large MSMEs. And so that would be the second benefit that we should have got. We have not put that in the numbers saying universal bank is coming so much advantage. But yes, if it does come through, then we will certainly like to move very quickly and gain the two advantages that we expect to see.
Okay. The last question, how is the collection efficiency trending as we see the shrinking SMA book projection? Have you seen any trends for collection efficiency improvement in Q4?
This is Raman here. Let me answer this question. Yes, indeed, collection efficiencies have been steadily improving in Q3. And we have the early reads for Q4 based on January. And what we are seeing is for bucket 0, for example, we are looking at well over 99%. And we've continued to achieve that for the last few months. And overall collection efficiencies has also been steadily going up for the unsecured book.
Okay. Thank you. Thank you so much.
Thank you. Our next question comes from the line of Harshit Jhaveri from CBA Asset Managers LLP. Please go ahead.
Yeah. Hi. Can you hear me, sir?
Yes, very well. Please go ahead.
Yeah. So my first question is that our cost of deposits, I've seen that have been sliding down. So do we know what is the incremental cost of deposits for the quarter, given the tightness in liquidity, and how do you intend to sustain the trend?
So it's fair to say that Q4 looks tight on liquidity, though I must say that today the liquidity in the system has really improved and costs have started coming down from today. And I think it is a lot of good work done by the regulator on managing liquidity in the system. But January was fairly tight. See, our fresh money coming into the bank is at around 7%, which is why we know that when we reprice our existing deposits in the Q4, that our cost of funds will come down to 7.5 because incremental money we are getting is at 7%. We are just hoping that we continue the strong growth rate that we've seen up to quarter three. But seeing today's experience, I think looks more likely now, though January was very tight on liquidity and certainly on deposit growth.
Okay. My second question was like, what is your view on the VC book and what will be the strategy around it over the coming years?
So first is our BC book. We had 17 BCs, 14 did very well. The 3 large ones didn't do well. They in fact had significant amount of NPAs and did cause us a challenge. I must say that all 3 of them continue to be our BCs. They're working hard on the recoveries. All 3 continue to have stabilized their collections. 2 of them are back to growing. 1 is still focused on collections, not growing. Also, we find a lot of gap in liquidity and capital in the MFI entities. We have seen a lot of MFIs come to us to become our BCs. Except the 3 BCs, we have had a good experience in the past, and so we don't distrust the model. We think the model holds very well. So we continue to grow our BC business. You will see the BC business in a positive growth first time in quarter 4. Also, I must add that our BC book has crossed the 99% collection mark first time in January. So we are very comfortable with what we see. And finally, I must add that we continue to put even our BC book under the guarantee program. So we are making sure that whatever we do within the bank, both in terms of what we apply as credit criteria, we apply the same to the BC book. Secondly, what we are doing in the bank of putting it under the guarantee program, we continue doing that for our BC book also. So in substance, yes, our BC business will start showing positive growth, and we do expect that it will give us additional tailwind as we go into next financial year, because we do expect good recoveries to come from them.
Got it. And so any reason for change in board members, and are you planning to add more board members?
So I guess you're referring to our presentation deck. So let me go there. Give me a second. It will be valuable for everybody else listening. It's on slide 27 is what I guess you're referring to. So it's very simplistic, which is, 2 of our board members are finishing the 8-year term, which is maximum allowed. And so they have to step off the board. One is our founder, Mr. Ramesh Ramanathan, who will have to step off purely because the 8 years is over. And second is our current chairman, Mr. Ramseshan, who will also be stepping down. So that's the reason why 2 board members. One is independent, Mr. Ramseshan. Ramesh Ramanathan is a non-executive, non-independent director. They'll be stepping down the board. We've already inducted Mr. Ajay Roti, who's a chartered accountant and has that as his primary background on the board. He joined us on 2nd of Feb. He was inducted. And Mr. Pankaj Razdan, who's had a very long and successful financial services stint, joining the board. Our existing independent board member, Ms. Chitra Talwar, she will take over the position as part-time chairperson, which has already received the RBI approval for the same. So really the board is seeing 2 veterans come off the board because they completed the 8 years on the board. And with God's grace, we've got very solid new board members, both independent, Ajay Roti and Mr. Pankaj Razdan, to come and fill up the board.
Got it. Thank you so much, sir, for answering my question.
Thank you. Thank you for the questions.
Thank you. Our next question comes from the line of Suraj Shinde from Yes Securities. Please go ahead.
Hello. Am I audible, sir?
Yes, Suraj, go ahead.
Hello, sir. So my first question is on the credit line on UPI. So given your strategy on 80% secured and 20% unsecured, seems to be an odd product for your launch as it will be unsecured in nature. So can you explain the rationale behind it, sir?
That's a difficult question, Suraj, but yes, let me. So one is our basic going in position was that we will be a anchor bank for our customers, which means full suite of all asset and liability products, which will give us operating leverage, will give us customer stickiness. And that was our going in position as a strategy when we began the bank in 2018. Now, the one product we did not have really in our arsenal. So we did all the products, what I would classify as middle India wanted, which is we had unsecured in terms of MFI, we brought in affordable housing, brought micro lab, two-wheelers, used cars, gold loans. But we never had a solution if somebody wanted to buy a consumer durable or somebody wanted to do a small education loan. Very difficult to administer that kind of a loan if you do it non-electronically. We felt that the card business was too much of a P&L drag in the formative years for us to launch. Thankfully, RBI approved small finance banks to do credit line with UPI. We think it is a great solution for us to then bring this last mile, the durable finance, the education loan, the last minute money that you want. And it will be delivered digitally, which is why credit line UPI was is a very important launch for us. Will it change our unsecured secured mix? Well, I can say the way we are growing, and given that credit line UPI will be a small ticket, short term approach for customers, where they'll borrow 15,000, 20,000, 30,000, 40,000, it will not change our 80-20 ratio in any significant way. We don't expect that to be a challenge. And I guess the answer to the question really is, and you can see even this year, our secured book is running much faster than what we anticipated. And with the launch of used car, with more products coming around on MSME, I still think we'll meet the 80-20 in spite of launching credit line on UPI. But we're very conscious that our commitment to do 80-20, that doesn't change.
Okay, got it, sir. And second question is on the gold loan, sorry. So, given that we have a very small book on the gold loan side, and we have a vast branch of network, so do you see a sustained high growth rate in the next few years, and how do you plan to manage the volatility in the gold prices?
So the first one is, live branches for Jana Bank is about roughly 550 branches. I would expect, even if you assume 8 or 10 crore average per branch, with this branch network, we should be able to deliver close to 4,000 odd crores as a outstanding. I do know that large gold companies per branch exposures are like 15 crores, but I'm assuming that since we are not a dedicated gold loan branch business, even if we reach half the number, which is about 8 crores, we should be a 4,000 crore book. I think that should give you a comfort that, yes, we should see our gold loan book growing at a fast pace for the next 2-3 years for sure. Nothing stops us from increasing our gold loan branches because our total branch network is now 820. And even if you minus our unbanked rural branches, where not many of them tend to gold loans, we still have another 100 odd branches to grow. So, sum and substance is, yes, our gold loans will continue growing faster. Second, on how do you manage the volatility? See, somehow, I must tell you that our LTV rates for gold loan is about 52.3%. That's the average LTV rate. We are very clear in our heads that we are making sure, especially when it comes to large ticket gold loans, we are looking at who the customer is and not just making sure that the gold is equal to a loan, but we are making sure that he has the ability to repay or sustain any margin calls in case the gold prices do drop. We don't see, unless there is something completely unexpected happens in terms of gold price halving or something like that, I can't see why we should have any challenge in the gold loan. It has behaved very well as a business, that I must tell you.
Okay, okay, great, sir. And sir, last question, if may I ask, so your CASA growth has been 40% year on year. So how sustainable is that growth?
So I guess 40 is a very, very strong number. I think frankly, if we continue doing the 25 to 30% as we go ahead, I think it will keep us probably at 2.5, 3x of the industry growth rate. That would be a fair estimation. It is not to say that we will not try to grow 40%, but I'm conscious that, it's been a very strong growth, and committing to that kind of a number would be a very difficult one for us. But fair to say that we'll be growing at multiple times the industry growth rate. Function of our new segment launches, function of our branch launches, RMs coming in, and of course our CASA ratio is just 20%. So I guess we still have enough and more room to grow for the next few years.
Okay, okay, sir. Thank you, sir, for your detailed response, and all the best for your future endeavor.
Thank you so much.
Thank you. Ladies and gentlemen, we take that as the last question for today. I would now like to hand the conference over to management for closing comments.
Thank you. So first I must tell all our investors and analysts on the call that while we are conscious that we could have probably worked harder and better, or at least read the tea leaves better in the last 2 quarters. And I think we missed doing that. We were more bullish than what the numbers finally turned out to be. But I'm glad that Q3 has kind of solved all of that. It's our job now to ensure that we get to the ROAs of 1.5, ROEs of 15, and we are very committed to do so. Everything that looked as a challenge, I think, at least in our mind, is addressed, and we continue on the strategic path of 80-20. And I thank you all for your patience and support. Thank you very much.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.